The event is great so far. You just came off of your fireside chat where you talked about some big macro themes you're watching. You say that the consumer is really kind of firing on all cylinders, that there's a lot of strength there still. They're still borrowing. Activity is high. But you juxtapose that to kind of the commercial sector, and you see that kind of moderating a little bit. And as we look ahead to the Fed minutes later today as kind of a news peg here, I'm curious what you think all of this means for the Fed's kind of decision-making as it pertains to monetary policy.
So I think if you think about the consumer is still spending more out of their accounts at Bank of America this year versus last year, about 4 to 5%. Last year at this time, that would have been 9 to 10%. So it's slowed down, and it's consistent with a lower growth, lower inflation economy. And that's good news, because the consumer isn't going south and is not spending. They have money in their accounts, their capacity to borrow. There's a lot of concern about the aggregate debt levels, but if you actually normalize them for the growth in the economy, they're kind of in the same place as they were pre-pandemic, so that's good. Commercial companies have to look at the world around them and everything they read, whether it's the wars and whether they could escalate, whether it's the Fed is going to hold longer, whatever the news of the day is, and you'll hear more this afternoon, or whether it's just worried about final demand. That's what's more concerning. So they're not using their lines as aggressively, which is an indication that they're not putting money to work quite at the rate, because it's more costly. The decision to borrow on your line now at 200 basis points spread over short-term funds is a 7.5% decision versus a 2.5% decision 36 months ago, 24 months ago. So they're going to be more careful, and that means that the investment rate has slowed down.
So putting this all together, there is this grand debate out there. I heard Steve Lee's been talking about this on the morning program on Squawk Box this morning, just about this idea of whether the Fed needs to cut kind of preemptively to make sure that some of these cracks that are kind of percolating under the surface don't come to fruition and push us into a recession. And others say, no, you need to follow the data. You need to make sure that you are, not being too easing in order to make sure that inflation is officially stamped out. Based on kind of your vantage point, where are you on that debate?
So our team, the research team, which is #1 in the world, has 3 cuts this year, 4 cuts next year, and they've revised theirs from 4 cuts down to 3 cuts. And that's this debate about whether the data that just came out in the last few weeks shows the economy and the inflation is coming down, but not quite at the rate people had hoped. And so they've got to have a clear path. The Fed's not being mysterious. They're saying we have to have a clear path down to the 2% target. We have to be well on the way before we cut. Now, the air potential is actually to not bring rates down and normalize soon enough, just like it was not to raise rates fast enough. And you can hear the Fed governors and the chair talk about, well, maybe we didn't move fast enough back before when you saw signs of inflation. They have the same possibility, and so that's what they're wrestling with. Our view is that our team's view is 3 cuts this year would bring the economy back into sort of equilibrium at the end of 25 with a Fed funds rate in the mid 3.5-ish.
My colleague Jim Cramer has a question for you back in studio. Jim?
Yeah, Brian, what price of anything is down from 2 years ago?
I'm sorry, Jim, I didn't hear you quickly.
I'm trying to figure out what price, house, car, rent, what is down so that we should feel confident that the Fed should cut?
At the end of the day is the pricing went up and wages went up. They just went up in 2 different cycles. And so the wage growth that occurred early in the post-pandemic cycle and the contribution from the government to them added a lot to consumers' firepower. The problem is then the pricing caught up with it. And now we're trying to get that back in equilibrium. So it'll take people get used to mortgage rates of 7%. Jim, you well know, because you're about as old as I am, so we've been around a while, that was what we used to think was a good mortgage rate. It's just that for 15 years we had no real rate structure, rate structure in the United States and around the world, and so people got used to lower rates. It'll take time to do that. That'll work itself through the system, and as rates normalize. The inversion of the curve has to be corrected. There has to be some changes made, but when you think about it overall, Jim, the reality is, yes, prices are up, but wages are up, unemployment's down, people are earning money, and so that's the tug of war that's going on. And they've moved the consumer to a different level of spending and capabilities. Will that hold is going to be an interesting question.
Yeah, but 12% mortgage for me first time, Brian. So, yes, we are similar age. Yesterday, kind of an amazing tie-up. Capital One with Discover Financial. Is this something that you think should be investigated by the FTC because it might actually cut back competition in the credit card business?
Jim, it's far from me to look at somebody else's deal and reflect on it. Honestly, Capital One and Discover made a major transformative discussion. It will concentrate in the credit card business. We're an effective competitor, $100 billion in balances, and great opportunity among our customer base to drive more growth. So I don't worry about the consolidation from a competitive standpoint, but that's someone else to judge on whether they have feelings about it or not.
What does it mean for your business as a credit card issuer? Because, this tie-up would make them the largest credit card issuer in the U.S. as measured by card loans outstanding at $257 billion. B of A has about $102 billion, so a sizable player there. But this creates a pretty significant competitor for you. How do you kind of assess the landscape if this deal does go through?
Well, at the end of the day, if you go back and look historically, after the MBNA transaction, Bank of America rose to the top of the credit card outstandings. We've been more cautious and direct on how we do it. We do it for our customers. We drive the business to be in affinity with our Bank of America customer base. We drive the business to have great credit underwriting. And in the world where we're talking about normalization of credit, we're talking about getting back to a 3% charge-off rate. We underwrite to higher rate tolerance and higher loss rate tolerance in that. We're underneath that. So that's good news. So being the biggest is not necessarily what we want to do. We want to be the best with the best rewards product, Preferred Rewards, which is integrated with our consumer franchise. 11 million customers are 70% of the balances in our consumer business that are tied in Preferred Rewards through their card, their checking account, the mortgage, the home equity. And that is where you generate real economic value for your shareholders. So we never said we were going to be the biggest in any business. We want to be the best in every business.
But is scale important here?
It is. But the scale, our scale and their scale is not much different. When you look at operating costs, if I were a $20 billion issue, it might be concerning. But at $100 billion plus, we did 4 million new cards last year. We're growing exactly the way we want.
So to recap, at Bank of America, they expect 3 rate cuts this year and 4 rate cuts next year. They said that should stabilize the economy. They said they're still seeing strength in the consumer. They said borrowing is still high. The consumer is spending less year over year, so that's good for what we want to show the Fed. They said an investment rate has also slowed down. They said the potential for error for the Fed is to not bring rates down and normalize soon enough. We know this. 3 rate cuts would bring the Fed funds rate down to 3 to 3.5% by 2025. He says prices haven't come down in the economy, but wages have come up to meet those prices. He stated that we had 15 years of no real rate structure, and now we have to figure it out. Capital One is to buy Discover. That would make them the largest credit card issuer in the U.S. So Bank of America CEO, he didn't really have too much to say about that, but that would take some share away from them. He says Bank of America is growing exactly how they want. Hope you guys enjoyed the video. Catch you in the next one.